Good morning. This is Robert Kaars Sijpesteijn bringing you this morning's market update. US stock markets were hit yesterday with a drop in the healthcare space as well as the energy sector, with oil prices dragging the market down. The US 500 lost 9 points to close on 2017.53. The US Tech 100 dropped 18 points to close on 4,413.2, and the Wall Street fell 38 points to close on 17,142. Ferrari had its first day of trading yesterday after capitalizing $893 million from its IPO. The shares rose to a peak of $61, however, has since declined to close at $55.21. Looking into commodities, gold dropped $9.50 yesterday to close at $1,166, and Brent crude suffered further losses, down at $47.86 a barrel after shaving 66 cents from the open. The annual meeting of the London Bullion Market Association usually involves a light-hearted debate on the outlook for precious metal prices, but this year delegates had weightier matters on their minds, a battle for the future of London's gold market. The battle could pit banks such as HSBC and JP Morgan, who own large bullion vaults and who have long dominated the gold trade in London, against rivals including Goldman Sachs and Societe Generale, who are active gold traders but do not have large gold storage businesses. The backdrop is a swath of new regulation that could open the London market to new technology and shake up the top participants in the world's gold trading hub. Approximately 3/4 of the world's bullion dealings takes place in London. The push for greater transparency has been seized on by some banks as an opportunity to push their vision of what the gold market should look like. Millions of ounces of gold a day change hands, and for any bank that can harness the trade flow or help run the new system, it could be highly lucrative. The gold market is being forced to reassess the way it does business because of new rules, many of them introduced in the wake of benchmark rigging scandals in foreign exchange and interest rates. These new regulations should bring more transparency to the market, as well as potentially more competitive pricing with high liquidity, which has caused a split between some of the big players. In Europe, the Germany 30 gained 62 points to close on 10,185.8. Arm Holdings, Merlin Entertainments and Sky all posted positive results yesterday. However, Pearson, which dove 16% after announcing full-year earnings would be lower than expected, dragged the UK 100 down. The UK 100 dropped 30 points to close on 6,309.6. Bank of England Governor Mark Carney supported Britain's EU membership in a major speech yesterday, highlighting its economic benefits while calling for reforms to ensure the Union still works in Britain's interest in the future. His intervention, made in a lecture at Oxford University, will be welcomed by David Cameron. Particularly pleasing for the Prime Minister will be the Governor's tone in his speech on Europe, which was identical to that of Mr Cameron in praising the benefits of Britain's membership of a reformed EU. Mr Cameron is understood to have encouraged Mr Carney to set out the issues for the Bank of England raised by a Brexit, even though the Prime Minister has yet to officially commit to leading the campaign for Britain to stay in the EU. Mr Cameron says he is awaiting the outcome of his renegotiation, but senior Conservatives are discreetly letting it be known they are happy for business leaders and others to start making the case for Britain to stay in a reformed Europe. In today's corporate news, Swiss investment bank Credit Suisse announced 2 new investment bank heads, Tim O'Hara and Jim Amini, as it reported a sharp fall in profits. Chipmaker Arm's revenue rose 24% to £243.1 million for the third quarter ended 30th of September, and it expects group dollar revenues for the full year to be in line with market expectations. Today's economic data in focus at 9:30 in the UK, public sector finances are released, and in the US at 3:30, crude oil inventories are released. That's all for this morning's market update. Thank you and goodbye.